Are you ready to unlock the secrets of a 7-figure crypto portfolio? The next bull market is almost here, and it's time to prepare. This means picking the right coins and tokens to maximize your gains and minimize your risks. Creating a robust crypto portfolio that balances the incredible risks and rewards of crypto is crucial. In this video, we at the early stage crypto team will guide you step by step on how to build the ultimate crypto portfolio so you can make the most of what could be the biggest bull market of your lifetime. Let's dive in. Before we begin, remember that nothing in this video is financial advice. It's purely educational content to assist you on your crypto journey. The first step to creating the ultimate crypto portfolio is understanding the risks and rewards associated with every coin and token on the market. While it might seem like you need to analyze every crypto in detail, focusing on different crypto categories is more practical. Cryptos can be categorized as large caps, medium caps, small caps, and stablecoins. Large cap cryptocurrencies have a market capitalization of over $1 billion. These cryptos have typically been around for a long time and have established themselves as top players in their respective niches. For example, Bitcoin BTC is the largest by market cap because it's been around the longest and has conquered the store of value niche. Large cap cryptos are considered low risk but also offer lower potential rewards because much of their growth has already occurred. Bitcoin's large market cap means it takes a significant amount of money to move its price up or down, which is good for minimizing risk, but not great for maximizing gains. On the other hand, small cap cryptos have a market cap of less than $100 million. These are high risk but offer high rewards. Most small cap cryptos are new and haven't yet established themselves as serious competitors. They could go to zero or skyrocket by 100x or more. Small market caps mean it doesn't take much money to move their prices significantly, which is excellent for potential rewards but risky. Mid-cap cryptos fall in between, with market caps ranging from $100 million to $1 billion. They are recognized but not fully established and can still see decent gains. Now let's talk about stablecoins, which don't just include tokens pegged to fiat currencies like USD but also commodities like gold. Stablecoins have their own risk and reward profiles. Most stablecoins are centralized and can be frozen at any time. They are often backed by volatile assets such as US government debt or bank-held money, which can pose risks. For stablecoins backed by commodities like gold, the biggest risk is price volatility over time. Despite these risks, stablecoins can be extremely useful. Now that you understand these categories, the next step is choosing a few cryptos from each category for your portfolio.
Unless you work full-time in crypto, it's unwise to have more than a dozen cryptos in total because you won't be able to keep up.
Ideally, you should have no more than 3 to 4 cryptos per category. However, the allocation ultimately depends on your risk tolerance. If you're young, have no debt, or are investing money you can afford to lose, consider accumulating more mid-caps and small caps. Conversely, if you're older, have lots of debt, or investing money you should probably be spending on other things, consider accumulating more large caps. And if you have a substantial amount of money already, you might want to focus on stablecoins. So, which cryptos should you consider for each category? The answer lies in the niches they fall into. For large caps, Bitcoin BTC is a must if you value a store of value. Most people in crypto hold BTC. Another logical addition is Ethereum ETH, the backbone of the entire crypto ecosystem. However, some argue that Ethereum's to reward profile isn't as good as other large cap cryptos because it constantly faces competition from other smart contract cryptocurrencies like Cardano and Solana. When choosing mid-cap cryptos, focus on utility tokens that power specific use cases or protocols. Pay extra attention to tokenomics because mid-cap cryptos tend to be tokens, not coins. For example, coins like Injective Protocol INJ are used to pay for fees on their blockchains and have multiple demand drivers, making them excellent mid-cap choices. For small-cap cryptos, speculation is the name of the game. These cryptos often don't have actual demand drivers yet, but could have significant potential. Focus on narratives that could cause a retail frenzy, like meme coins. Remember, small-cap cryptos are often temporary investments. They might go up 10 to 100x in a short period, crash, and eventually drift down to zero. When retail investors start pouring in, it's time to get out and rotate your profits into more promising large caps and mid caps. Now, let's talk about your stablecoin allocation. Just like with large caps, mid caps, and small caps, your stablecoin allocation should be diversified. This is partly because of regulatory uncertainty around stablecoins and partly because different stablecoins have different attributes. Here are some popular stablecoins to consider. 1. Tether USDT is widely used in DeFi and supported by many exchanges. It's true to crypto but has faced scrutiny over transparency. 2. USD Coin USDC is highly regulated and used in DeFi. It's supported by many protocols but allied with some controversial entities. 3. Paxos Standard Pax is known for its regulation and transparency. It's not as widely supported but offers a secure option. 4. DAI is a decentralized stablecoin backed by crypto assets. It's widely used in DeFi but can be volatile if the underlying collateral fluctuates. 5. Paxos Gold PAXG is a stablecoin backed by gold. It offers a hedge against fiat currency volatility but isn't widely supported by DeFi protocols. Diversifying your stablecoin allocation helps mitigate risks associated with any single stablecoin. Stablecoins can also be used for lending, providing liquidity on decentralized exchanges, or earning yields. Some stablecoins allow you to earn yield directly from the assets backing them, which can be very lucrative if you're already sitting on a lot of money. Balancing risk effectively in your portfolio is crucial. One strategy is the core and satellite approach. The core of your portfolio should consist of large-cap cryptos and stablecoins, providing stability and lower risk. The satellites are your mid-caps and small caps, which offer higher risk and higher potential rewards. This balance helps ensure that your portfolio can withstand market volatility while still offering significant growth potential. To build a resilient portfolio that's diversified across the 4 categories, a good sample allocation might look like this. Allocate 50% to large-cap cryptocurrencies. As we mentioned, Bitcoin and Ethereum are solid choices. Consider adding other established players like Cardano or Solana to spread the risk. Next, allocate 25% to mid-cap cryptocurrencies. Look for projects with strong use cases and growing ecosystems, like Chainlink for its Oracle services and Aave for decentralized finance. Allocate 15% to small-cap cryptocurrencies. Identify projects with innovative solutions and strong communities, but be sure to research thoroughly and be prepared for high volatility. Projects like Injective Protocol or other emerging DeFi solutions could be considered. Lastly, you might allocate 10% to stablecoins like USDC or PAXG to provide both stability and liquidity, as these can be staked or used in lending protocols to earn passive income. Remember, it's crucial to manage risk while also attempting to maximize returns, which requires a few key actions. One trick is to set stop-loss orders to automatically sell a cryptocurrency if it drops to a certain price to limit losses. Another is to regularly take profits during bull runs to lock in gains. You could also reinvest in stablecoins or large caps for stability. Also, be sure to avoid high leverage. While leverage can amplify gains, it can also accelerate and increase losses. For most investors, especially beginners, it's best to avoid it. To put it all together, create a portfolio that includes a mix of large caps, mid caps, small caps, and stablecoins based on your risk tolerance and investment goals. Remember to store any coins and tokens you're not actively trading in a personal crypto wallet, ideally a cold wallet for maximum security. And if you're curious which coins have made us 10x life-changing returns, click right here to watch the video where we expose our financial freedom creating crypto portfolio with a few underrated tips and tricks to amplify those 10x gains in your own crypto investing strategy.